Yeah, well, when London's closed, you can materially move the price of gold and silver with the futures market in New York. It does influence the spot market, or has historically. It's becoming less important now that we've got true shortage in the market, and we see the spot price, the cash price for gold and silver, or sorry, for silver is above the futures price, the December's futures price still. This is even after an injection of 50 million plus ounces in the last month back into London after their available metal ran dry in that market. So, and that to me is the crucial thing. Is we had visibility in October of a market basically pausing or stopping into a forced stoppage because of lack of silver liquidity offered into the market. So New York is a hedging market. It's a futures market. London does offer forwards, but more than 90% of the trading there is in the cash or the spot market for immediate ownership and immediate delivery. And even the forwards that they offer there require.
The precious metals complex has often shown structural stress beneath reported prices over the past year. That stress is real. It appears in lease rates, severe backwardation, and London market delivery frictions that cannot be explained by normal trading cycles. Andy Schectman and David Jensen discuss physical market dynamics, London's cash market versus New York futures, LBMA forward generation, and non-ETF metal availability. They do it from the perspective of daily delivery and storage users. Prices are either written adjustments or signals of a physical squeeze depending on those mechanisms. David Jensen has extensive mining and physical metals knowledge, focusing on where real metal occurs, how it flows, and how contractual frameworks affect deliverability. Since London is the global reference point for physical silver price discovery, most mining contracts and commercial settlements use it, making its operational health a systemically important variable. When the daily cash price market shows chronic backwardation and delivery delays, those are not temporary aberrations. Operational red flags affect producers, consumers, and major holders. Schectman and Jensen recommend investor signals: continuous backwardation where spot exceeds futures, spike-level implied lease rates, exhausted free float once ETF inventories are eliminated, and sudden substantial metal injections into London vaults that momentarily relieve pressure. These signs indicate a market where paper claims, the notional ounces on trading displays, gradually outweigh the physical ounces available for delivery. This asymmetry is a structural tailwind for gold and silver investors thinking in months and years, with silver especially vulnerable due to its smaller industrial to monetary float and current demand profile. Importantly, Jensen portrays this as more than a technical curiosity. It is an operational mismatch that might cause acute price discovery when participants must take delivery rather than settle paper positions. If the market has defaulted, even locally or rolling, price discovery is through the cash market and physical participants who must obtain metal. The ramifications are clear for investors who have long seen precious metals as financial insurance. Physical market scarcity risk boosts the deliverable metal holders' upside. Kindly enjoy the video, subscribe for future deep dives, and comment below before we begin. Please enjoy the video and thanks for supporting us.
Yeah, well, when London's closed, you can materially move the price of gold and silver with the futures market in New York. It does influence the spot market, or has historically. It's becoming less important now that we've got true shortage in the market, and we see the spot price, the cash price for gold and silver, or sorry, for silver is above the futures price, the December's futures price still. This is even after an injection of 50 million plus ounces in the last month back into London after their available metal ran dry in that market. So, and that to me is the crucial thing. Is we had visibility in October of a market basically pausing or stopping into a forced stoppage because of lack of silver liquidity offered into the market. So New York is a hedging market. It's a futures market. London does offer forwards, but more than 90% of the trading there is in the cash or the spot market for immediate ownership and immediate delivery. And even the forwards that they offer there require you to acquire a spot contract in order to create a forward. So if they say, well, we have some forward trading here, and say, yeah, but those contracts are all based on a spot contract as well.
Right. Now, you've described the LBMA as being structurally fragile. And you just mentioned that the market where the spot price is higher than the futures price, this is called backwardation, and something that we saw to an extreme level a few weeks ago.
Yeah.
And then, as you mentioned, the infusion of 50 million ounces, kind of a lifeline, took care of that. But here we see a slight increase in backwardation again. In your view, the backwardation, along with perhaps maybe you can discuss the unallocated positions and the overwhelming volume of paper, gold versus silver versus physical, explain what are the key points of failure that you see, maybe starting with the backwardation.
Yeah, well, we did see on October 10th, the market seize up in London. And that is despite the fact that they had roughly 790 million ounces in the vaults in London. But of that 790 million ounces, approximately 650 were held by exchange traded funds, so should not be offered into the market. And the remainder, which was approximately 140 million ounces, was not offered to market. So what we got there, Andy, was on that day, we caught a glimpse of where the bottom of the barrel was. And the London market actually bounced into that bottom of the barrel. So even with 140 million ounces not available, not held by the ETFs, there was no silver liquidity in London. So we know that market is tapped out circa 140 million ounces of non-ETF gold. So with the addition of, notionally with the addition of 54 million ounces to that market, they've got a little bit of liquidity. But I mean, even the LBMA now in their statistics state that they're trading on an active day, they're trading more than 700 million ounces of silver every day in the cash immediate delivery market, immediate ownership and immediate delivery market. So if you've got 50 million ounces, but you're trading 700 million ounces a day in these cash contracts, and that speaks of an open interest or total claims in the market of at least a couple billion ounces, you can see how weak this market is, and that the market has actually failed. It's just a matter of the London market has failed. It's a matter of it, silver purchasers recognizing this, and I think what we're seeing today with these 4+% price moves after the price had come off 10-15% here a couple of weeks ago.
Continuing their market mechanics discussion, when delivery is uncertain, hedging platforms and commercial counterparties operate differently. Certain COMEX laws allow compulsory cash settlement, and the futures market has historically moved paper prices. However, London's privately negotiated spot contracts are governed by contract law and require real metal movement to satisfy claims. Jensen notes that when a cash market that ordinarily clears on rapid delivery cannot source metal, supply alters. Metal previously traded as leasable inventory is hoarded or reclassified, revealing latent demand from industry, strategic purchasers, and bullion houses. The conversion of latent to explicit demand drives price appreciation. Jensen believes London's latest metal injections, while necessary to prevent a market seizure, are not a long-term solution. If the structural imbalance persists, they purchase time but do not restore free float. The disparity between deliverable ounces and outstanding claims is exacerbated by smart money driving physical accumulation. Investors get procedural and tactical knowledge. Allocating to immediately deliverable metal outside of pooled or unallocated positions reduces counterparty exposure and obtains physical scarcity premiums.
Is that investors and purchasers are stepping in to acquire what little silver is left in that market. London right now operates on a silver in, silver out basis. If they get silver, they can deliver some silver. If they don't get any, they are unable to deliver silver. And we saw that from that signal. They've got a 50 million ounce buffer right now, but they are dependent on continual deliveries of silver to meet delivery demand from these cash contract holders.
Yeah, I cite your information regularly, and when we talk about the LBMA, they for a good portion of the year, it's a T+1 exchange. T for the trade day plus 1 to settle on the third day. Those bars should be moving.
Yep.
But as you know, it was 8 weeks because we were told the Bank of England had a shortage of manpower and trucks. And I cite your figures regularly in the respect that, you say there's roughly 2 billion ounces of deliverable contracts out there against a 140 million ounce float. What could possibly go wrong? Or trading 700 or 800 million ounces a day in deliverable contracts against a 140 million ounce float. What could go wrong? Or even Bruce, I forget his last name, Ikamoto. I'm sorry, yeah. Bruce. He talks about 3 million ounces of platinum traded every day with 0 platinum in the vaults. What could go wrong? My question to you, that I think is paramount to your analysis, is how confident are you in the LBMA's reported trading volumes and inventory figures? Kind of the same way I wonder, the CME group, how accurate are their figures on the Commitment of Traders report? But how confident are you in the LBMA's reported volumes in trading and in inventory figures?
That's a good question. It's very difficult to say. You're dependent on these the banks, which have on numerous occasions shown themselves feeling free to operate outside the law. Number one.
Yeah.
But I mean, in 2013, the LBMA was indicating that they were trading about 2.5 billion ounces of silver a day in the cash market. 2.5 billion in a world where you're producing 800 million ounces a year. Now suddenly that number has dropped to around 700 million ounces a day. So we really don't know. It's an opaque market run by banks which have been charged with fraud on numerous occasions. So we really don't know. But the idea that the 140 million ounces is afloat, I mean, that's the amount of silver not held by ETFs. But if you want to talk about a free float, what is available to London when you're at the 140 million ounce level right now, the free float is 0.
It's the 55 million ounces that they got injected in there.
Right after that. So we've got about 50, and we don't even know of that 50 million ounces, how much of that is held by private investors who are willing to deal that into the market. We do know the benchmark on October 10, there was 140 million ounces in the vaults not owned by ETFs, and that the free float on October 10 was roughly 0.
Wow. That's crazy. That's really crazy. And now we get into some questions that I think kind of try and connect the dots. So we've talked about the internal weaknesses, but the external dynamics are shifting rapidly too. And let's start with talking a little bit about the global East versus the global West shift. Now, for years, all of us have talked about this steady flow of physical metal from West to East, with China now centralizing its metal through the Shanghai Gold Exchange. And now we're told restricting silver exports, along with the U.S. classifying silver a critical mineral, and they too can restrict exports. Do you see more so forget about the U.S., I just want to throw that in there as a plus. That's happening too. But do you see what's happening in Shanghai as a direct challenge to the LBMA's role in global price discovery, and maybe even more so towards market dominance? Is this a real threat over time?
Well, I guess it depends on the various axes of power, who aligns with whom. When we look at the BRICS nations and the countries that are friendly to the BRICS, it's more than half of the world's GDP now, and we really rely on the London market in terms of price discovery of gold and silver, in terms of feeding information into the bond market. We learned historically in the 1970s how essential gold and silver were as a warning system of excess currency creation. Silver went up by 24 times in 9 years, and gold went up by 21 times in 9 years between 1971 and 1980. And in 1987, the LBMA was created, and the daily fix, as they called it, gold and silver, was created using these promissory note contracts, which essentially moved the market away from trading metal to a market that traded promises for immediate delivery of metal. And for more than 20 years thereafter, we had the gold and silver signal was switched off while very loose monetary policy was run by these central banks. They called that, the Wall Street Journal wrote an article in the 1990s talking about the Great Moderation, which was that, this is incredible inflation after we've dumbed down the inflation measure through the CPI is showing us that we've got no inflation, and gold is telling us that we've got no inflation, and yet asset prices are going to the moon. And this is, we've really hit now on central planning, monetary policy nirvana. And I think what we're going to have come out of all of this, Andy, is a fragmentation of the world's gold and silver markets away from these major centers. And everything is going to become local and governed by local law.
Yep.
And I think that capital investment and acquisition capital is going to go to the trusted sources for metal, and that is still to be determined. Which markets are going to be trusted, but I think China would like to be the focal point of the world's price discovery and become the dominant force. But there's lots of we've seen unbelievable levels of corruption in China over the decades, and I think people would have to be quite naive to look at these now as the fair dealers in terms of setting the global price of gold and silver. So I think that everything becomes local after this, and it's who has the metal and where are the repositories located in terms of laws that enforce the contractual right to acquire metal.
So if you were inside of a major bullion bank or central bank today as an advisor, what's the one thing that you'd be most worried about when it comes to the LBMA's future? And as an aside, to your last point, do you see any signs that perhaps key institutions are quietly preparing for a breakdown or a shift in the system?
Well, the first part, if we've got of the order of, let's say, 2 billion ounces of claims in the market, and we have $100 price move up in the price of silver, if those claims have been underwritten, offered into the market by the banks, $100 move in the price of silver translates to a $200 billion liability. And that gets quite messy quite quickly on a bank balance sheet. So that would be the biggest concern is
Three overlapping dynamics govern the upside size and speed. The first is deliverability evolution, whether bullion banks and custodians can source incremental metal at scale and regularly, or if each patch becomes tougher to repeat. Second, demand composition, industrial and strategic silver needs in electronics, solar, and other areas. Reduce paper market elastic supply using a consumption floor. The third is market psychology. Market behavior changes to promote structural scarcity, including longer holding periods, reduced willingness to lease or lend, and more bid-side aggression. Jensen's opinion that we've witnessed a default followed by a rolling sequence of strains is essential since defaults reallocate risk non-linearly. If counterparties reprice counterparty delivery and settlement risk into physical metal bids, a little price shift may not reverse. That repricing turns technical backwardation and high implied lease rates into price increases. It also means that futures or forwards may lag the cash price for a considerable time, favoring holders of allocated immediately deliverable metal and producers with solid offtakes. Finally, precious metals combine monetary, industrial, and geopolitical influences. Central bank actions, currency dynamics, and strategic national reserves affect gold and silver supply and demand. Jensen's structural fragility warning is not limited to technology. This macro signal can boost monetary asset flows. Investors who value capital preservation and asymmetric upside should allocate to physical metal and closely watch the operational indications Jensen and Schectman discuss in the discussion. If this helped, like, subscribe, and ring the bell for more data-driven precious metals market news. Please specify the indicator you want tracked weekly: lease rates, backwardation, vault flows, or ETF inventories. We'll prioritize the most requested. Thanks for watching.